Good morning, ladies and gentlemen. On behalf of 12 Capital, I would like to welcome you to today's webinar on the topic, It's Time for Insurance Debt. My name is Thomas Frey and I will guide you through the webinar today. For those participants who do not know 12 Capital yet, we are an independent investment manager focused on the insurance sector with headquarters in Zurich and offices in London and Munich. In addition to subordinated insurance debt, we invest also in insurance equities, cat bonds and ILS investments, private debt, and very soon also in private equity. Just briefly about our two speakers. Mr. Etienne Schwartz has been with 12 Capital for over 9 years now. He is responsible for all our multi-asset strategies, where insurance bonds are a big part of it. Vittorio San Giorgio has been with 12 Capital for more than 8 years now, and he is responsible for all subordinated private debt strategies. Now I wish you an interesting presentation and hand over to Etienne. Etienne, why is it time for insurance bonds now?
Thank you very much, Thomas, and also welcome to today's webinar from my side. It's time for insurance debt. Indeed, we believe that the sector once again offers an attractive entry opportunity, and we would like today, in today's webinar, show you how the insurance sector differs from other sectors and why, from a risk-return perspective, it might make sense to allocate to subordinated insurance debt. The insurance sector has been very resilient in the past. This is also due to the very strong regulatory framework that we have in Europe, for example. And as a result of this resilience and the attractive spreads we already observe now for a couple of years, the long-term investor who was staying in that asset class over the past years really made a good return. Despite this fundamental defensive nature of the insurance sector, insurance subordinated bonds offer a complexity premium and often can be bought at a discount when the market basically has an elevated volatility, as we can currently observe it in today's environment. We see this as really a good entry opportunity, and that's why we actually set up this interesting, hopefully, webinar. But before we go to the market data, I would like to hand over to Vittorio. He will provide you with some additional background on the insurance sector.
Thank you very much, Etienne, and welcome everybody to today's webinar. I will start today's section by giving you a little bit of an introduction of what makes the insurance sector special and what makes it different from corporates. There are 4 key elements I will go through and I will cover in more details, and this will provide you additional color around the unique features of the insurance sector. First, the sector has an inverted cash flow profile, which is different from the corporate ones. Second, there is a balance sheet structure which is specific, and there are dedicated accounting rules. Third, and I will stress this point specifically, the sector is regulated and there is a strong regulatory oversight, which is a key strength for the sector. And lastly, the sector remains very granular and is also underpinned by country-level specificities. All these elements together contribute to what is the perceived complexity of the sector, which together with the limited sell-side coverage translate in what we call a complexity premium. If I move on into more specificities, I will cover first the cash flows. So if you think a typical cash flow profile of a corporate, it involves upfront financing to fund production and research, and then the sale of products and the generation of revenues. Insurance companies work completely differently. First, they will receive upfront payments, so the premiums get paid by policyholders upfront. Then this money that is collected is set aside and invested. Also, it's important to flag that a part or all of the proceeds for these investments will be ultimately retained by insurance. So this will generate an additional revenue stream for them. And third, only in case of claims, this asset will be sold, liquidated, and then proceeds will be used to pay policyholders. So this highlights very clearly how insurers do not need short-term liquidity financing. And I give you an example. If you think back in 2020, during the COVID crisis, there was a rush to liquidity from a lot of corporate sectors, and this was not the case for insurance companies that didn't need to fit liquidity gaps. I will move on to the next slides that is showing you a little bit the typical structure of an insurance balance sheet. As you can see, I think the important side is the liability side. Most of it is made up of technical reserves. What are these? These are the amounts of money that the insurance company expects to pay to policyholders in order to cover the claims. The remainder is made up of subordinated debt and equity. These two together, they form the capital resources of an insurance company. It is important again to flag that in the typical balance sheet side of an insurance company, you do not see senior debt. Why is this important to mention? Because it means that subordinated debt we invest into, it is indeed subordinated, but it's subordinated only to policyholders. And these next two slides will be covering the very important regulatory oversight of the sector. There is first a very important message that we believe that the regulation and the sector actually benefits from the insurance sector benefits from regulation, and this regulation enhances the creditworthiness of the sector. In fact, if you think, in order to operate, insurance company needs to hold a certain level of capital, they have to have governance in place, they need special reporting, they need risk management. So it sets already a certain barrier of entry for companies that want to operate in the insurance sector. Specifically, if you think about capital, insurance companies are required to hold a minimum level of capital in order to operate. This can be created, and the insurance company can be funded by three different ways. Equity is the most permanent form of capital and also the most expensive for them. There is subordinated debt, which is senior to equity, and also it can have different features. We'll see it in a moment. And lastly, there is reinsurance. Reinsurance can help alleviating capital requirements, but is also typically short-term and can become either unavailable or too expensive, given the market dynamics of the reinsurance world, which are highly cyclical. One last point about regulation. If you look at the sector through a ESG lens, we also believe that regulation improves very much social and governance aspects. I will cover these at the end of the presentation. Few words about what happened in Europe. Europe is the key area of investment for our strategies. And in Europe, the regulatory environment has materially evolved with the introduction of Solvency II. It's a little bit what happened in the banking sector with the introduction of Basel regulation. From these slides, there are two key takeaways. If you look at the left-hand side, you see that the framework for subordinated debt with the advent of Solvency II became much better defined and much clearer. There was an introduction of Tier 3, Tier 2, and Tier 1 debt, which have different level of seniority, and also clarifies the structures of what can be counted as capital for insurance companies. On the right-hand side, you will see what also are the two consequences of the regulation of Solvency II. First, there were higher level of solvency capital required by the sector. And secondly, capital ratios became more volatile. This is a consequence of the fact that Solvency II has a mark-to-market approach. These two elements combined led to an increase of demand for subordinated debt from insurance companies, which is positive for us and investors, and also generated a healthy pipeline of issuance. If we look back over the past 2-3 years, we can see around 20 billion of debt issuances in Europe alone on a subordinated insurance space. I will finish this section with these slides. There are again two key messages here. On the left-hand side, you see this map, and this map shows you that the sector is deep and investable. You can see the figures in the boxes, and for example, in Europe, you see that there is almost 200 billion of liquid blue chip subordinated debt available to be invested. It also shows you that the market is deep in the US, in Americas, in Europe, and also in other geographies. At 12 Capital, we focus only in geographies which are highly regulated and well developed, specifically Europe, the US, and Australia. What is also important to flag, and also goes back to the theme of complexity of the sector, is on the right-hand side of the chart. The sector remains very granular on a country level. For example, two neighboring countries might have completely different fiscal treatments of life insurance contracts. There might be different gap accounting rules. There might be different mandatory coverages, for example, death covers in case of mortgages, MTPL, and so on and so forth. All these specificities make markets different, make markets dynamics different, and therefore makes the sector a bit more complex to assess from a generalist investors. And this clearly shows the importance of what is active research and sector knowledge, which is ultimately what 12 Capital does. And this is key for those which are interested in investing into the sector. After this brief introduction on the fundamentals of the sector, I would like to pass it back to Etienne, that will be covering a little bit the attractiveness of the sector from an investor perspective.
Thank you, Vittorio. What we can see on this slide here is a comparison of excess yields over the 10-year Eurozone government bonds, and they are roughly trading at 1% at the moment. What we choose here is a selection of 5 different asset classes. We have, for example, the Euro stocks here, the dashed blue line representing the equity space. We see there at the moment roughly 2.5% spread. That's the dividend yield here in this case. We also have real estate investment trusts. The dashed gray line here is roughly trading at 1.8% spread. Then we have in the light blue line, that's the high yield BB index, and clearly this one shows the highest spread with currently around 3.5% spread. And what is also important, and that can be observed in this chart here, is that if the market is in an elevated stress mode and if volatility spikes, high yield clearly also suffers, and the volatility, like in March 2020, goes up quite severely and significantly.
Etienne, sorry to interrupt, but there's an interesting question on this from the audience. Maybe I can ask it. The question is, how would you position insurance bonds against high yield on a long-term view? High yield definitely have a much higher default ratio, but are there other differences?
Yes, that's a good question. There are other differences, and maybe Vittorio wanted to take the question.
Yeah, happily. There's a key fundamental difference between high yield and insurance. And this can be found in, for example, the leverage ratios and the fixed charge coverage of the two sectors. If you think of insurance companies, they have relatively low and manageable leverage ratios and very strong fixed charge coverages on average. On the other hand, if you look at high yield, you typically have higher leverage ratios and weaker fixed charge coverages. Why this is an extremely important point in this current market environment? Because we are in a rising rates environment. Rising rates environment will translate most likely in higher cost of debt, which will be more detrimental for high yield, while it is very likely manageable for insurance sector. So indeed, this moment is probably the perfect time to reallocate and to allocate to insurance debt relative to high yield, because of the really strong fundamental in this really very important point around leverage and fixed charge coverage for the sector.
And maybe to finish off the slide, we forgot the most important ones. One is an investment grade index, BBB, currently trading also at 1.7, 1.8% spread. And then finally, the subordinated insurance debt universe. And what we can see here, that for investment grade content, that's important to flag here, the subordinated insurance debt space pays roughly 80 or 70 basis points more than other sectors in the BBB area. So there is really a big spread pickup that is achievable, and maybe also worth to flag here in this context is that active portfolio management clearly also still improves the returns, meaning that by avoiding the big blue chip companies, Allianz, AXA of this world, we can really go beyond 3% spread, even 3.5% spread in our actively managed portfolios. And one of the key questions here is, why exactly are these spreads so elevated? are there hidden risks, and one of the risks might be duration. Duration risk is clearly not the issue in the subordinated insurance debt space, as we can see it here. The insurance debt universe has actually a lower or similar duration profile than the investment grade area, and that really shows you that there is clearly not a significant pickup in spread. What is also worth to mention is again that we can basically lower the duration even more in our actively managed portfolios, and that's what we do at 12 Capital. So the duration profile is in most cases even lower.
Etienne, here's another question from the audience which might fit in the slide you just explained. The question is that one of the results of the actual market situation are higher inflation rates and increasing interest rates. Does this development have a positive or negative impact on insurance sector, especially insurance debt?
Yes, if we look at insurance debt, we have to look at it from two angles. One is the bond structure itself. It's a fixed income instrument, so it has duration that makes it prone to interest rate sensitivity, and clearly a bond then also falls in terms of price or has a mark-to-market adjustment. But very important, and that's a key differentiating factor of the insurance sector, insurance companies on the fundamental basis are positively geared towards a rising interest rate environment, most of them at least. And especially for life insurance companies, that's very much the case. One example is that they can reinvest the premiums at a very or higher rate, and that gives them a better margin in the end. And with that, I would like to hand over to the next slide, where we also see another factor of risk. So it's not duration risk, clearly, and it's also not default risk. That's what we can observe over the last 40 years. S&P did this study here for us. We can see that insurance companies actually have the lowest default rates across all sectors. And the defaults that we can observe here in this chart are defaults due to the global financial crisis, mainly mortgage insurance business, which basically went bust in the US, and we don't do this kind of business. In Europe, it's important to flag under Solvency II, the insurance companies hold roughly 2.2 times the capital that the regulator requires them to hold, which really shows how big the cushion in terms of capital is that these insurance companies have. Last but not least, maybe a more recent development, the geopolitical tensions in Eastern Europe. Here is also worth to mention that if we look at these tensions, the insurance sector is really only limited exposed to this kind of events. If you look, for example, at the asset side of insurance companies, international players have rather minor exposure. Looking then at the liabilities, the losses and claims are currently being estimated in the area of 10 to 20 billion. Most of these losses are coming from aviation. And to put this number maybe into perspective, a small to mid-sized hurricane in the US causes this kind of losses and can, let's say, easily be digested by these local insurance companies. And if we put this into broader perspective, the big players don't have an issue at all with this kind of losses. So it's clearly not a capital event. Maybe it might be an earnings event for some insurance companies, but not to worry at all for the insurance debt space at the moment.
Etienne, sorry, there is a short question, in addition question to interest rates and higher inflation from the audience. Someone is asking that this is definitely more positive for equities, but not much positive on the bond side. Is that correct?
It's correct in a sense that clearly the bond clearly has a mark-to-market impact, but from a fundamental perspective, solvency ratio goes up. So basically it's a better credit after all, and that's not the case if you look, for example, into the high yield space, where the creditworthiness generally tends to go down because they have higher leverage, because they need to basically serve this with interest rate payments. So the credit is more solid, and there might be an upgrade also in terms of rating in this kind of scenario.
Okay, thank you.
And maybe I hand over then to Vittorio again, who will go into our ESG approach.
Thank you, Etienne. I will close with some remarks around ESG. First, let me say that given the sector role in the redistribution of wealth across generations, and also given the strong sector regulation, we see that insurers have strong ESG credentials. It is also important to understand that the ESG aspects for insurance companies have to be assessed in a very holistic way. At 12 Capital, we look at both sides of the balance sheet of an insurance company to assess ESG risks. On the right-hand side, you see technical reserves. So we look at technical reserves to understand what type of risks an insurance company underwrites. Is this something controversial? Is it something related to a particular risk we don't want to take? On the left-hand side, you see cash and investments. So this is how insurance company put money at work. So basically, how do they invest the premiums they receive from policyholders? It's important that you look at both sides of the balance sheet. When it comes to how we do ESG internally and how we look at ESG internally, we have a multi-step approach, and we integrate ESG in the portfolio construction of most of our products and through different steps. So the first step is that we have an exclusion criteria that looks at the involvement of each insurer into certain lines of business I was mentioning before. Secondly, we then assign a proprietary ESG ratings based on 17 questions on each instrument. And we derive this information from either internal knowledge, as we are expert of the sector, or external data providers. Third, we integrate this rating into the portfolio construction. And fourth, we continuously engage with issuers on ESG themes. This is typically as part of our interaction with the issuers when we assess and monitor creditworthiness over time. I would like to finish maybe with a couple of words around why 12 Capital and what is the distinguishing factors that make 12 Capital really best positioned to benefit from the opportunities currently available in the insurance debt space. It's very important to flag that we have a first mover advantage. We have been active in the field since 2010, so we are investing for over 12 years into insurance debt. Secondly, 12 Capital is a set of almost 50 professionals based in 3 different geographies with a strong and extensive background in both insurance and investments. Third, we have a holistic approach. As Thomas mentioned it at the beginning, we invest into collateralized reinsurance, equity, fixed income. So this approach towards the entire investments in insurance allows us to have a better access to transaction and have a better access to the best potential investments for our end investors. And fourth, we can leverage on an in-house proprietary credit, legal, and ESG frameworks, which ultimately enhance investor protection and they help selecting the best investment opportunities which are currently available in the market. With these comments, I would like to hand over the word to Thomas for some final remarks and also to answer some of the questions that you might have during the presentation. Thank you very much.
Yes, thank you very much, Vittorio, and also Etienne for this interesting webinar. There are indeed some additional questions from the audience. The first one may be interesting for you, Vito. The question is that sectors most exposed to downside risk are expected to be banking, consumer cyclicals, and some industrials, whereby the insurance sector is expected to continue its defensive play. Does the insurance sector remains an investment grade safe haven offering similar yields like high yield?
That's a very good question. Thank you, Thomas. I think there is a few messages that I would like to pass on. The first one, think about the extremely strong track record of insurance companies over multiple crises. A great financial crisis, Eurozone peripheral crisis, COVID, the current times we're living in. So first, very strong track record, and the sector remained investment grade and solid through this crisis. Secondly, I think that is important to flag what also Etienne mentioned before. The sector is positively geared towards higher rates. So higher rates that are beneficial for solvency ratios, which is a key message to bring home, and also tells you that the sector is well positioned in the current environment. And third, I think also, which is another theme, current protracted potential inflation, it is clearly not particularly beneficial for the sector, but most of the insurance companies are typically repricing their contracts on an annual basis, and they're typically retail-oriented, which means that they are able to pass part or most of this inflation back to policyholders when they reprice these contracts. So I think you have a relatively good answer to inflation, positive gearing towards interest rates, and third, an extremely strong track record over the years, which makes the sector very well positioned to remain as strong as it is in the upcoming month.
Okay, thank you very much. And here's another question coming from the audience, maybe for Etienne. No other sector has much regulatory oversight like insurance sector. Investment grade rating, stable capital positions like the insurance sector. Why does 12 Capital believe that the insurance is the most mispriced sector?
That's a good question, and we get asked this question quite often, and I think it's at least threefolded. The biggest part of the answer is, in my view, the complexity premium. It's, as Vittorio outlined during the presentation, a complex sector with a strong regulator, dedicated accounting rules that are very specific. And that also means that it takes a lot of effort to research the sector. And that's simply not something that most investors tend to do. They don't put in this kind of costs into research to analyze a rather niche sector from the outside view. So that's one key answer in my view. The other one is that the ECB was not allowed to buy subordinated insurance debt in the past. That clearly didn't help to compress the spreads in a similar way as it was the case for other sectors. And then last, insurance companies themselves, they don't invest into insurance bonds. And as one can imagine, there is quite a lot of capital in this balance sheet, which is then basically missing on the demand side of the spectrum here. Yeah.
Thank you very much, Etienne. There seem to be no additional questions from the audience. But before I close the webinar, I want to take the opportunity to give you an advance notice for our next webinar, which will take place on June 14th. We will give you there a forecast of the upcoming hurricane season. This is especially for cat bonds and ILS investors definitely an interesting topic. If you have any additional questions, please feel free to contact our sales team. We're always happy to help. For the moment, I thank you very much for your interest. Stay well and goodbye. Thank you.